With all the uncertainty in the world at the moment, many people are feeling a bit nervous about what the coming months and years may hold, particularly when it comes to their financial position. Which is why I wanted to take a moment to talk about our approach to investment and how we've applied it over the last year or two. Those who partner with us will be familiar with our overarching investment goals. The number one goal being to do no damage and do everything possible to ensure our clients' income needs are met. They don't go backwards over time, and that they never find themselves having to sell good assets at a low price just to meet their income needs. Now, to do this, our investment portfolio is carefully positioned to achieve realistic and sustainable returns with a target of inflation plus 3 to 6%. Now, I don't want to, and I won't, bore you with a whole lot of financial jargon about the intricacies of this. But essentially, we work off the premise that we never know what is going to happen tomorrow, next week, or next year, in good times and in bad times. And this means we take a more cautious and defensive approach to investing our clients' hard-earned and actively manage their investments. At an individual client level, we deliberately invest an appropriate proportion of their wealth in defensive assets like cash, bonds, and income securities, which typically provide a lower but more stable return, so that if there is a downturn, their income needs can be met for at least a 5-year period, and they won't be forced to sell good quality assets at a subpar price. The remainder is invested in growth assets to a level that the client is comfortable with. You see, we believe it is far better to be fearful when others are greedy and greedy when others are fearful. Sensing possible instability in the market and the potential for a significant downturn over the last 12 to 18 months, we've deliberately started moving our growth portfolio from the front of the wave to the back of the wave. And while we're yet to see how things play out in the Middle East, Europe, the US, and even Asia in the coming months, we firmly believe that this strategy is highly likely to ultimately work in our clients' favour. If our thinking is wrong and there is no downturn, the outcome may be that our growth portfolio returns a little less than a fully exposed portfolio, and we are okay with that. But if our thinking turns out to be correct, and there is a significant downturn, like the GFC in 2009 or even the tech bubble of the early 2000s, we expect the negative impact on our growth portfolio will be significantly less than most of the market. And because of our deliberate positioning, we're likely to be in a position to go shopping and buy good assets at heavily discounted prices, like we actually did last October, and find ourselves fully invested again. We take this position because we've seen the devastating impacts significant downturns can have on investors and the repercussions of that on them and their family for years to come. Potentially missing out on 1 or 2% to avoid that devastation is a trade-off that, in my experience, most people are happy to make. In fact, instead of being fearful of a downturn, many of our clients look forward to the opportunity to go shopping when things are cheap. Because like all good shoppers, they know it's better and smarter to buy the shoes when they're on sale than pay full price.